What's going on, everybody? Liam O'Reilly, Vermont economic realtor with Jerry Riley Real Estate. I hope you're doing well. Today we're going to talk about the debt ceiling and what that means for the housing market. We're going to look at this article that Zillow wrote, making some predictions using research and data to analyze what could happen if the debt ceiling isn't extended, if the debt limit isn't extended at the beginning of June here, which is about a week away. So let's get right into it here. The title of this article, which is in the description for you folks, a debt ceiling default would send the U.S. housing market back into a deep freeze. So what they talk about, the main key points of this article, and we'll go through them, is that they think that there will be fewer transactions going on in the housing market if the government defaults on its debt, or the debt ceiling doesn't get extended. Not necessarily that they don't pay their bonds or pay their interest obligations, but that they don't extend the debt ceiling. They think that that's going to cause less activity in the housing market in general, but it might not result in a massive housing price crash. So let's get into exactly what they say here. And I think the key factor into all this, one, this is all speculative, right? That we don't know what would happen if the debt ceiling doesn't get extended, because we haven't seen this before. And so a lot of this is just speculating on what could happen based on a hypothetical scenario. And as I'm sure many of you know, that it's not likely that this is going to happen. It's not likely that the debt ceiling isn't going to get extended. But regardless, a big thing to take into account is that these scenarios and what Zillow is predicting here is based on if the government decides to prioritize spending on or making their debt obligations versus prioritizing government employees and things along that nature. So the government continues to pay its bond obligations as opposed to paying government workers. So, and that's what they say here. Where do they say it? They say it at some point in this article. I'm not going to highlight that portion unless we come across it. But let's talk about exactly what's going on. So federal expenditures alone account for 34% of GDP in the first quarter of 2023. Hitting the debt limit would mean the federal government can only spend as much revenue as it receives each month, no longer able to issue debt to finance a running deficit. So for context, I accidentally clicked a link there. For context, the federal government was in ran a $1.3 trillion deficit last year. So they'd have to cut spending by about that much. All right, so here we go. Such a large reduction in spending would necessitate furloughs, among federal and state employees, and is likely to trigger waves of layoffs of contractors and other employers who are indirectly connected to federal spending. And right, you can see how this could ripple across the economy, because if there's mass layoffs across government workers, what is that going to mean for people spending money in the economy, and these people who used to have stable income and used to be actively spending in the general economy? What's going to happen to them, and what are they going to be doing if they're not making any money? So what they say here, they're predicting that mortgage rates will increase to 8.4%, which I thought was pretty low, relatively speaking. If we look at where mortgage rates are at now, they're at 6.5%. And that has a lot to do with what's going on in the treasury market. The 10-year treasury is up a little bit, so it's at 3.7%. And you can see here the 1-month treasury, so treasuries that are going to be maturing in June those are up 20 basis points just today alone. So 5.8%. Clearly the highest yield on your treasury bill is in the 1-month category because of this risk of default. So 8.4% of mortgage rates, which is it's going to cause a handful of things to happen. We already know with these higher mortgage rates, what we've seen is a reduction in demand, right? Less people can afford to purchase properties, but at the same time, it's caused sellers to stay put. Now, if we see mortgage rates shoot up to 8.4% or higher than 8%, I think that's going to cause less sellers to bring their homes to the market, and it's also going to discourage builders to bring properties to the market because there's less buyers out there to purchase property. On top of that, if unemployment rises, there's even less buyers out there to purchase property, which of course is going to discourage building. So the reason why they don't think that, even though if rates shoot up to 8.4%, that this isn't going to cause a huge crash in prices. If we look at this scenario here, this scenario is because of where inventory's at. And if we take a look at Redfin's inventory chart here, so active listings of homes for sale, it's up 2% from last year, but it's still well below the gray line, which is 2020's level, and is sitting right about 2020 and 2022's inventory level and is trending downward. So there's hardly any homes for sale. And if we look at new listings coming to the market, we're kind of in between where we were last year and the bottom of 2020 during the pandemic, when everything was shut down, people were scared, not a lot of homes were being brought to the market. So there's not a lot of new listings coming to the market, and inventory remains relatively tight. So what they expect is just a slight decrease in average home price, despite interest rates shooting up to 8.3%, unemployment potentially rising to 8.3%. And transactions, let's see if I can find out where they say that. They say transactions are going to slow by 23%. Here we go. We estimate that existing home sales would fall as much as 23% relative to the no baseline forecast later this year. Home values may be 5% lower at the end of 2024 than expected in a no default scenario. So that's what they say here. If we go back to the price chart. So in a no debt default scenario, if the government doesn't extend the debt ceiling, they project in 18 months that home prices nationally are going to be 6% higher than where they are today. Now, if we look at what they project if the government does default, or the debt ceiling doesn't get extended, then we're likely to see just a 1% increase. And the reason why, I've said default a lot in this video, but I think a better way to look at it and a better way to think about this is just the extension of the debt ceiling as opposed to a default, because I don't think the government is going to stop paying its debts. At least it doesn't seem like it will. The government wants U.S. treasuries to remain strong and to remain a stable, a reliable asset that countries can invest in, so they can keep people buying in, keep people purchasing their debt in the future. And if the government doesn't extend the debt ceiling and decides not to pay the treasuries that they've already issued, then that's gonna cause people to lose confidence in the treasury market, and could hurt the U.S. debt issuance in the future after this is all sorted out. So some things that I wanted to leave you folks with, and some things to think about, is what would happen to rents if this happened, right? If unemployment skyrockets, and if interest rates skyrocket, and there's less buyers that are out there, but at the same time there's also less sellers, so inventory is still relatively tight. I think it will increase. It will increase from where it's at today, but it's still relatively tight. And there's less buyers out there. What's going to happen to rent? I mean, I think we could see rents uptick slightly, even if unemployment's high. People are going to start getting roommates, and they're going to opt to not pay for homes because homes are expensive and interest rates are high. But they're going to opt to become renters and find creative ways to do that, which is going to put upward pressure on rents. Is something that I think could happen in this scenario. Something else to keep in mind is, if you're a home buyer and you're looking to buy in the near future, and this does happen, I think the best opportunity could be ahead of you. If interest rates shoot way up, even though homes are more expensive, that could cut down on the amount of buyers in the market. And then when rates eventually come back down, I think that's a good opportunity to jump into the market. Now, if you're a home seller, I think if rates shoot way up, you're not really going to want to sell unless you're forced to sell, unless you have to move, unless you're selling a second home because you need the money. There's just going to be less buyers out there if rates are at 8.4%. So if that's the case in this scenario, you should again, continue to price your property accurately. You're not going to want to overprice it. You're not going to want to, have people coming in well under list price. I think, pricing it accurately, trying to capture the few buyers that are out there will be important, and making your listing stand out among the other homes in your price range will give you the best chance at getting top dollar and selling relatively quickly. So anyway, Lee Morale, Vermont economic realtor. Leave a comment. Let me know what you think. I always love hearing from you folks. Do you think the government is going to extend the debt ceiling? What do you think is going to happen? And how do you think that's going to affect the housing market? Other than that, all my contact information is in the description. If you're looking to buy or sell a home here in Vermont, I'd be happy to help you. If you're looking in another state, reach out to me as well. I'd be happy to find a great agent in whatever area you're looking in. And I'll see you guys in the next video.